Hello and welcome to another special edition of Unplugged. We are rolling from the Goregaon Sports Club and my guest today is someone who wears many hats, Sunil Singhania. Sunil, thank you so much for joining us.
Thanks for having me.
Sunil is the CIO in equity at Reliance Mutual Fund. Is also the first Indian to be on the global board of CFA Institute, an all-India rank holder in chartered accountancy, and also on the management committee of this beautiful Goregaon Sports Club. How do you manage so many things, Sunil?
I think it's all about passion. The way investing is all about passion. I think you have to be involved in a few things other than the work, and I think it gives you energy. It gives you a lot of a different kind of perspective.
Okay, so tell me which work you enjoy the most, being the CIO of Reliance Mutual Fund, or being member of this beautiful club, or being member of the CFA board. All of them, in their own right, very big positions.
So I think the biggest passion obviously is investing. I won't deny that. So investing is the life, the blood, everything. But I think sports and this club specifically gives me a lot of energy. Specifically on weekend, I meet my friends. We spend a lot of time here on weekends. It keeps you, sort of, at least in that frame of mind of trying to be healthy. And the CFA position gives definitely a global perspective. I have the honor of sitting alongside 17 other board of governors who are luminaries in their own right from different parts of the countries, and I think it's the biggest learning which anyone can hope to have.
Okay, Sunil, this is something I've been wanting to ask you ever since I did that interview with Madhu Kela. He told me that Sunil, of course, is more than a colleague; he's a friend. But more than that, he is my balancing partner. Whenever I get too bullish, Sunil comes and says, Madhu, you are getting, out of line. Just temper down your optimism. Is that right?
So I think, I frankly have the honor of working with Madhu, and it's been a great, almost 13, 14, 15 years. So I think the Madhu has awesome qualities, and specifically, getting the gut right, being a little bit more aggressive in execution than maybe I am. But at the same time, I am a numbers person. So whenever hope takes precedence over fundamentals, I think, I always try to be a little bit cautious. So maybe he was referring to that,
Are we going through that phase right now?
In a lot of stocks, yes. In a lot of stocks. And you have to be careful. Only one difference, Anuj. What is happening is, I've repeated it time and again. Maybe, the 15.5 times earnings, which we were accustomed to for the last 15, 20 years, is changing. Because the world is in a situation where liquidity is available in plenty. The cost of debt has fallen to, all-time lows. In US, we have 1.5%. In Japan, you can borrow 40-year money at negative rates, and so on and so forth. And same is the case with equities. There's so much liquidity that even equity is available in plenty. So I think maybe the weighted average cost of capital calculation, which we do in our calculation, that itself has come down, and that might warrant raising of the normalized PE band, maybe 10-15% higher, and that is what we're seeing right now.
But we 10-15% higher is fine, Sunil, but we are trading much above median valuations and maybe near historic high valuations. But of course, that's global in nature right now. Do you get a sense that something bad could happen globally and the market is not prepared for that? Do you get that ugly feeling sometimes?
So one is, I won't agree that we are at historic high valuation. I think we have reached situations where we were 30 PE in 2008. Right
now
we are
an aberration.
Yeah. So aberrations keep on happening. That's not to say that it can't happen this time. I'm just, making a point. Yes. The other thing is obviously, you have to be looking at or analyzing your positions or your investments on a day-to-day basis. And as I said, there are stocks, there are sectors where it is getting out of hand. But whether they can still rise 15-20% before falling, that can always be the case. But as experienced investor who have burned their fingers time and again, over so many years, you tend to get a little bit more wiser. So I think that phase is frankly good for us.
In your own industry, do you think valuations are getting out of hand, the NBFCs?
So niche NBFCs, there's a lot of potential. Frankly, making money in NBFC suddenly is becoming so easy.
Yes.
There are companies where the market cap is multiples of their AUM, not the book or the price earnings. So I think you have to start taking a call. And one exercise which we normally do is try to analyze what the market price is discounting at this point of time. So if a company is trading at say 40 PE, unless you can justify that in 4 or 5 years that company's earnings can triple, it would be foolish to pay a 40 PE. Same is the case with NBFC. Suddenly it has become so easy, you raise money at 3 times book, again you become 2 times book, and again people say that you will become 3 times book. It's becoming too easy, and there is huge potential in this space, but you have to be cautious on some of the names.
One thing we've learned is that making money in stock markets is not easy. So does that itself raise some alarm bells that now it's become easy? There's a good chance that at whatever price you buy some of these NBFCs, you would have made money.
So one is, I did not complete on the NBFC. I think there's a portion of niche NBFCs where we feel there is still a lot of value to be unlocked, and I always again say that India is behind the world, and that is an advantage, because what has happened, advantage to us as investors, because what has happened in the world is ultimately going to happen in India. So niche NBFCs which are going to be beneficiaries of the shift from physical savings to financial savings, like mutual funds, life insurance companies, wealth managers, I think they will make a lot of money.
Let's talk about some more issues, Sunil, and we'll come back to, of course, some of the recent market issues. You are an extensive traveler, I believe, and wherever you go, you try to meet the big fund manager in that city. When did that process start? And tell us 3 or 4 anecdotes where you have met someone big who has left a lasting impression on you.
So I've been fortunate to be associated with the CFA Institute right from 2003. And I have had the benefit of not only traveling across the world, but also meeting really senior guys all over the world. So there have been instances, there was a board member, very senior from Morgan Stanley, and there are small sentences which they make. He says that you should never buy stocks of a company whose chairman is your very dear friend, because all the good news will keep on coming to you, the bad news will never come to you. Similarly, I went to Chicago once, and I happened to meet a fund which was focused on mid-cap investing, and the book written by Ralph Wenger, which is a Zebra and Alliance country. Yes. I think it was very opportune, because at that point of time in India, no one was looking at that category of stock. It was just after Lehman. It was 2011-12. Equities were out of fashion. Specifically, everyone wanted to be in the most obvious names, which is what this book is all about. That Zebra move in herds, and everyone wants to be in the center because there's this false sense of security. But it's the zebra at the side who get to eat the best grass, and they run the fastest when the lion comes in. So that was all about mid-cap investing at that point of time, The large caps were trading at multi-year highs, and there was no buyers for those kind of stocks. So I think these kind of anecdotes, keep on sort of adding that little bit which you need to keep yourself going on.
That worked very well in 2008, and I remember, reading an interview of yours where you moved to high-risk, high-return, stocks. You said time to be defensive is over now. It's time to just go out and buy some of these, high-risk stocks. Are we still in that phase, or is it time to get into some bit of defensives now?
So frankly, I don't understand frankly the definition of defensive and aggressive. Like IT can be defensive, but it's not performed at all. I'm just giving an example. So I think what is basically the definition of defensive, where there's sustainable growth, and obviously high risk is where the growth can be volatile or it's not as obvious. So I think at this point of time, a lot of defensive stocks, specifically on consumer staples, have very low growth. So if you're growing at 5%, 7% in volume terms, for us to justify a 35-40 P for them becomes a little bit difficult. Having said that, India is a great country, it's a huge country. We are coming out of that cycle where standard of living is improved, and some of these consumption names might, spring a surprise. But if you're banking on India going from 2 trillion to 4 trillion, which at least we believe, we have good monsoons, GST is behind the back, government, a lot of action is happening, demand is reviving after 3-4 years. So you might suddenly see some of these so-called, companies which are not growing, like the capital goods space, suddenly spring a surprise. So I think, yes, selectively you have to start looking at them.
Okay. Sunil, you recently went to Montreal as well, and you met, a big market guru there as well. You want to tell us about that story?
So, obviously Montreal or Canada, largest investors there are pension funds. So I met the CIO of one of the large pension funds stationed in Montreal, and I think in May, that was a big trigger point, at least for me. So I think the bottom line was that they had to generate 6-7%, or they have to generate 6-7% return on the corpus to fulfill their pension obligations. The world is such that they're not even able to generate 2%. And they were looking at countries which had relatively stable currency, which India was and is even now, and which were able to give them 11-12% on a longer time frame, and where they could invest in size. So I think it was very clear that, commercial real estate, whether it's a fixed rental, road assets, power assets, utilities, they will all be lapped up eventually, or it's a matter of time, by some of these large pension funds. We are already started to see the first phase of it. At least, I and in fact, as a company, we remain very, very positive of huge flows coming into so-called boring sectors, which give you 10, 11, 12% ROE, but over a period of 20, 25 years. So I think that was something which was, frankly, at least, we had not thought of in such great detail.